the equity section. It's short. It was only 6 readings. We are beginning the final reading in the equity section. It's short. It was only 6 readings long, 2 study sessions, 6 readings. This last one is called Equity Valuation, Concepts, and Basic Tools, and this is the heart of it. This is, I think, what everyone waited for, this final chapter, because it has the one with the most learning objectives that begin with the word calculate. And it's not as difficult as one might imagine. It does get a little bit more challenging as you go up through the levels, but for level 1, the final part of this reading says concepts and basic tools, and they are quite basic. So let's begin with LOSA, which is to evaluate. And what are we evaluating here? Whether a security, given its current market price and a value estimate, is overvalued, fairly valued, or undervalued by the market. So we're introducing some terminology. I've used these terms quite often throughout the reading, so I think this should be just kind of a review. The overall goal of equity valuation, I've written it down, the first line here, is to identify mispriced securities. We want to buy undervalued securities if we possibly can. Now, somebody may make a comment saying, look, if I'm an income investor and there's a fairly valued security with a nice dividend, why wouldn't I buy a fairly valued security? Point. That is a good point. So we can buy undervalued securities and fairly valued securities. What we don't want to do, or at least try to avoid, is to buy overvalued securities. So what we are looking for here is cases where intrinsic value does not equal market value. And we'll find that while we may be able to arrive at a statement like that, we might not have a lot of confidence in that statement. So let's get some terminology. IV, I will use for intrinsic value or fundamental value. MV will be market value. So here are 3 scenarios where we have our intrinsic value and our market value, and our intrinsic value can be less than our market value, equal to, or greater than. So if the market value is the greater of intrinsic value, we have an overvalued security. The market is overvaluing it. If it's equal, fairly valued. Now, when we think about equal, there is only one point at which it can be equal, to the penny. So it's kind of equal is what we would say. And I have a certain rule that if whatever the market value is, whatever intrinsic value I get to, if it's within 10 to 20% above or 10 to 20% below in that band, I would call it fairly valued. So let me give you an example. Let's say that there's a stock that has a market value of $20. Now that means 10% down is 18 and 10% up is 22. If I come to an intrinsic value that's in between the band of 18 to 22, I would call that fairly valued. A stock that's $19.20 on an intrinsic value basis with a market value of 20 for that 80 cents, I would say, you know what, I'm in the ballpark. It's fairly valued, and no stock just stays at $20. If you watch any stock, they'll trade within certain bands, and that might be the fairly valued band. So up or down 10%, that's fine. Notice what I've written here. It depends on the confidence of the inputs. If you have more confidence, you'll use tighter bands. If you have less confidence, you'll use wider bands around fairly valued. I've seen up or down 20%. So you take a $100 stock, and if it's anywhere within the range of 80 to 120, the analyst might conclude, given that there's some uncertainty about the level of the inputs, that if the market value is anywhere between the 80 and the 120, they would tend to call that a hold or a fairly valued security. And then, of course, market value can be less than the intrinsic value, in which case we're looking at an undervalued security. So all of this depends on our idea of what's overvalued, fairly valued, or undervalued. Of course, depends on our confidence in the inputs, but it also depends on the time frame we expect this to happen over. So we may find an undervalued security, but our holding period might be 6 months to a year. We would have to ask, well, sure, it's an undervalued security, but will it reach, or will it move towards its fair value within the time frame that we're holding? And sometimes the answer might be no, that something might be undervalued, but it might take a long time period for intrinsic value and market value to converge. Here's the deal. You don't know. Nobody really knows how long it's going to take. Only experience teaches you that, well, given this sector and given that this just happened and this is out of favor or this is in favor, the cycle before this comes around might be 3 to 4 years. So you might be building a position knowing that you've got a 3 to 5 year holding horizon. If you've got a 6 to 12 month holding horizon, you're going to need something that's closer to the market's eyeballs as opposed to something that's deep value. That those deep value stocks, they take a while for the market to come around to that. So you have to look at your time frame as well to determine whether, even if you find something overvalued, whether or not it's worth it, given that you may have limited time. So this is something I've tried earlier in this reading, and I had asked for feedback on the video. Do you like it? Do you not like it? And I got some saying, we like the questions, they're all right. And then I got some comments saying I'm not a big fan of the typing. But it's hard to do the questions without the typing, right? So I'm going to go through questions every now and then because I think it's a great way to introduce new ideas without actually just listing them out. Anyways, let's begin here. An analyst finds that all the securities analyzed have estimated values higher than their market prices. The securities all appear to be, and I'll look at my options, over, under, fairly. Okay, so I've got to pick one of the three. So I'll go to what scenario I have. They all have estimated values higher. The estimated values are higher than their market values. Well, a situation like this where the market value is below the intrinsic value would be undervalued. Now, typically, if you have a scenario where every time you send a security through it, your model is spitting out this scenario consistently with every security, that looks like a biased market. That does not look like an efficient market. It looks like a biased market. The market is undervaluing all the securities. You would not run to say, what an inefficient market. Everything is undervalued. You would seriously question your model. You'd say, there might be something wrong with my model. That's not one of the options we're given, so we must make a decision. If this is the case, let's go with the rule, it's undervalued. Look at the next one. An analyst finds that nearly all companies in a market segment have common shares that are trading at market prices above the analyst's estimate of their values. So here we have a case where market values are coming in greater than intrinsic value, which would imply that all the securities are overvalued. This market segment is widely followed by analysts. So, if it's widely followed by analysts, this is a bias that seems wrong. How could the market be that biased, that inefficient, when it's widely followed by analysts? Which of the following statements describes the analyst's most appropriate first action? So when I look at my answers, issue a sell, issue a buy, or re-examine, that's what I'm going to do first, re-examine the model. Always be skeptical. If you're running a model, if you're looking at 10, 12, 15 stocks, and they're all coming out on the same side, overvalued, 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 don't run to that conclusion. Be skeptical. Just look at your model and say, I must be missing something because everything's coming out the wrong way. I'm doing it wrong. I'm missing some input. So you want to re-examine the model. An analyst, using a number of models and a range of inputs, by the way, this is the right way to do it, a number of different, you don't just use one and come up with one price, use a number of different models and a range of inputs, you triangulate that price. Estimates the security's value to be between, and this is what will happen, you'll get a range. A range of prices that you think that it should fall between, as opposed to IV equaling MV strictly. It's more of a range. The security is trading at 265. The security appears to be, well, it's within the range. We would say the security appears to be fairly valued. All right, we're on LOSB. Our keyword here is to describe. Describe major categories of equity valuation models. And there are three that are presented in this reading, or three major categories. I shouldn't say three. Three major categories. The present value models, multiplier models, and asset-based valuation models. And we really don't have to go into a lot of detail here other than just, give us a high-level view. Present value models, well, you've been through quant. I guess we all know what discounted cash flow is, and this is what it is. The cash flows that we're discounting are either future dividends that will be paid, that is called a dividend discount model, or future cash flows that would be available to pay dividends. Models like free cash flow to the firm, free cash flow to equity. We're looking here at present value models for the present value of the future benefits to be received from the security. Multiplier models. Here we're looking for a market value or an enterprise value multiple, where the price that we arrive at is some multiple of some fundamental variable. For example, price to earnings or price to sales. Stated on a forward basis, on an estimate. So we would have some estimate of what earnings would be, or of what sales would be, and we'd come up with a forward price to earnings or a forward price to sales, or on a trailing basis based on observed values. So rather than estimating future values, we would take the estimates over the last 12 months and we would look at our current price and come up with a price to earnings multiple based on the trailing 12 months. And if you're ever looking at a PE ratio and you see right at the very bottom TTM, that means trailing 12 months. It's based on a trailing basis, not a forward basis. Finally, asset-based valuation models. Here we take the estimated value of the assets, and from that we subtract the estimated value of the liabilities plus the estimated value of the preferred shares. You really wouldn't value too many businesses based on an asset-based valuation model. Financial-based companies where the majority of their assets are financial assets, sure. Businesses that are close to liquidation or really have no going concern value, you would use an asset-based valuation model. All right, let's look at two questions from LOSB. An analyst is estimating the intrinsic value for a new company. The analyst has 1 year of financial statements for the company and has calculated the average values of a variety of price multiples for the industry in which the company operates. Analyst plans to use at least one model from each of the three categories of valuation models. The analyst is least likely to rely on the estimate from the... Now, before we look at the answers, look what I do. I always look... Here's the deal. Every year I get these mock exams, and I do them. I do a mock exam just to see what I score. And I'll still get about 15 to 20 questions out of 240. I'll still get about 15 or 20 of them wrong. But when I look at them, I'd say about 3/4 of the ones I got wrong is because I misread it. I answered most likely as opposed to least likely, or I didn't see the least likely part. I saw something else I didn't read. So I like to underline exactly what's being asked. The analyst is least likely. It draws my attention to that. Least likely to rely on the estimate from, well, in the question it's telling me I only have 1 year of financial statements. 1 year. And that there's an average of price multiples already calculated. So I think, well, which one requires more than 1 year? A multiplier I can do with 1 year. A present value? I can't do that with just 1 year. I need future estimates of cash flows and dividends. An asset-based valuation model I can do from 1 year. Not well, but I can. So I'm least likely to use the present value model. Now, here's the deal. If this is all you got, none of this is going to give you a very good price. None of it is, because you only have 1 year of financial statements. It's a new company. So you're not likely to use much of this. You're likely to use more of a descriptive story to come up with a valuation, and use something called a comparable to come up with a valuation as opposed to any one of these. But the question says least likely. You got to read that. And there we go. Based on the company's EPS of $1.35, earnings per share, an analyst estimates the intrinsic value of a security to be $16.60. Which type of model is the analyst most likely to be using to estimate intrinsic value? Well, this looks like a price multiple to me. Multiplier model. That should be fairly straightforward. We are on LOSC, our keyword here, describe. We got quite a few things here to describe, but it's really not a lot. Describe regular cash dividends, extra dividends, stock splits, reverse stock splits, and share repurchases. So it sounds like a lot going on there, but it's really straightforward. A dividend, that is a distribution paid to shareholders based on the number of shares owned. There are regular cash dividends and extra or special dividends. And if you've been through the FRA playlist where we compared Costco and Walmart, you saw that Costco every 2 years, above their regular cash dividend, issues an extra dividend or a special dividend. The regular cash dividend is paid at regular intervals, typically quarterly. And the extra or special dividend is paid by a company that does not pay at regular intervals or does pay at regular intervals but uses it as a supplement. The nice thing about the special dividend over the regular cash dividend is it's not expected. That the extra cash dividend suddenly doesn't become this expectation from shareholders that you're going to pay that every single time. Dividends, no matter whether they're regular or extra, are not legal obligations. When we get to the next learning objective, I will tell you when a dividend does become a legal obligation. But when we say it's not a legal obligation, it means they are discretionary. They can be canceled at any time. You cannot do that with coupon payments on bonds. They are declared and authorized by the board of directors. A stock dividend. This is a bonus issue of shares. Additional shares issued, typically 2 to 4% of your holdings, instead of cash. This has absolutely no economic value to the shareholder and no economic value to the company. Shareholders' wealth is not increased. There are simply more shares, but the value of the company hasn't changed, so everybody's shares are just worth less. But the overall holding you have is not worth any more. It is not relevant for valuation as such. Stock splits and reverse stock splits, same thing, not relevant for valuation. It has no economic effect. A stock split is meant to increase the number of shares in the marketplace. So something like a 2-for-1 stock split where if you have 100 shares at $50, you now have 200 shares, but at $25 each. So the price per share, P0, the price per share gets lowered, gets cut in half. If it were a 3-for-1 stock split, the price per share would be cut to 1/3 of its original price. A reverse stock split decreases the number of shares outstanding in the market. So like a 1-for-10 reverse stock split, if you had 100 shares, you'd get 1 share for every 10. You'd now only have 10 shares, but the shares would be worth 10 times as much as they were. You'd still have the same wealth that you had before it happened. Here, the price per share increases. Typically, companies do reverse stock splits when their share price is below $5. So let's just put that $5 mark in here. If it's below $5 a share, they'll typically do reverse stock splits to bring the price up. The reason is there's a lot of large funds that won't consider anything under $5. Another threshold is the $1 threshold. At $1 per share, depending on what exchange you're on, you might be in danger of being delisted. So rather than keep your price at $1 per share, you'll do a reverse stock split to get it up. Stock splits are meant to bring your share price down to a more manageable level and attract a larger base of shareholders. There's something uncomfortable sometimes about buying a $1,200 share, like Amazon is right now, $1,200 a share. You want 100 shares, you're spending $120,000. That's not really doable for a lot of different investors. All right, the last term we have to describe in this learning objective is share repurchases. Now, this does have an economic effect. Share repurchases are used as an alternative to cash dividends. When you give me a cash dividend, I have income that year that I must claim and pay tax on. Now, I'll probably get some benefit from the tax man because I received a dividend, typically a lower tax rate. But if you give me a capital gain, and I don't take the capital gain, I have no tax hit. So as far as I'm concerned as a shareholder, companies, instead of paying out that dividend all the time, use that dividend and buy back shares, reduce the share count, which boosts the price of all the shares. My wealth is still increasing by the same amount. I'm indifferent between the two, but I have a deferred tax event in a capital gain. It's unrealized till I sell it. So there is quite a bit of value in the share repurchase. Company uses cash to buy back its own stock. This is what the transaction looks like. Treasury stock is debited, cash is credited. So money leaves the company, buys back its own stock. An account in the equity section called treasury stock is set up that holds a debit balance. But the accounts in the equity section hold credit balances. So we can see that this is going to be a contra account. It's called a contra equity account. And just so that you can see it clear in your head what a contra equity account means, think of your balance sheet, think of property, plant, and equipment. It has a certain amount in there, and we always know that we take off accumulated depreciation, right? Well, accumulated depreciation, that is called a contra asset account. PPE is the asset account. That's a contra asset account meant to reduce the asset. Well, treasury stock is a contra equity account. It serves the same purpose. It reduces the amount in the equity accounts. The shares in the treasury stock account, these shares are not considered for dividends, for voting, or for computing earnings per share. Reasons that a company would want to buy back its own stock. A, signal a belief that their shares are undervalued. If they're going to buy back their own shares, they're sending a message to the market that, look, we have a lot of different things we can invest in, but we think right now our best investment is buying back our own stock. B, flexibility on amounts and timing. Here's the thing with a share repurchase. Once you announce a share repurchase, you don't have to do it. You can just not do it at all. You can say, look, we are announcing a $5 billion share repurchase over the next 2 years, and over the next 2 years, you don't have to spend a penny if you change your mind. Not just that, you get to decide when you want to buy back your own stocks. You can wait until there's weakness in the market, and maybe you want to step in and support the share price at a certain level. You can step in and do it at those particular times. So you got lots of flexibility on the amount that you do eventually buy back and the timing of it. Tax efficiency, you're delivering capital gains to your shareholders versus dividends. And D, nullify the effect of employee stock options. So there's going to be stock options. Stock options, you have to give shares to the employees. Well, you can give them from treasury stock, or after a period of time that there have been stock options granted, even any dilutive security at all. You can then step in and do a share buyback to nullify the effect of any of that. All right, LOSD, describe dividend payment chronology. And big changes to settlement in the last year. It used to be for equities T+3 on settlement, which means after you bought, it took 3 days for the stocks to settle. We're now down to T+2. So our chronology this year will look different than chronologies of previous years. So here's a timeline and just some imaginary dates here. May 29th. September 28th, September 29th, and October 21st. So let's say on May 29th, the company comes out and says, we declare a dividend. That's called the declaration date. When a company declares a dividend, they will give 2 dates. They will give a holder of record date, and they will give a payment date. So they will say, we declare a dividend of so much money per share to all shareholders of record as of some certain date, to be paid out on some certain date. Now, once they declare that dividend, dividends are now contractual. That specific dividend is now contractual. They must pay it. It is non-discretionary at that point. Dividends as a whole are discretionary. Companies can cancel them at any time, but once they are declared, that's it. September 29th is the holder of record date, which means you have to be a shareholder of record on that date. Well, now we have to worry about settlement because you have to own the stock before September 29th. Well, settlement is T+2. I write down here T+2, which means on the 27th, it says here to be a shareholder of record on September 29th, you must buy the stock by the close of September 27th. So if you buy it by 4 p.m. on the 27th, by the time it settles on the 29th, the company knows that you own so many shares. The very next day, September 28th, one day before the record date, that's called the ex-dividend date. The stock begins trading without the dividend. The day before is called the cum dividend date. It's Latin, meaning with the dividend. So it'll be trading with the dividend on September 27th. It begins trading without the dividend on September 28th. Now, since the company is paying dividend or dividends, it's parting with cash. Since it's parting with cash, it's parting with some of its assets. So on the ex-dividend date, the stock price will adjust for the amount of the dividend. So here's September 28th up here. Here's a stock price. And on the morning of September 28th, when it's ex-dividend, it will drop down. It will open lower. The stock will just open lower by the amount of the dividend. Now, that's a naive thing to say. Typically, it's a pretty straightforward statement. It'll open up lower by the amount of the dividend. But you're going to see at level 2 that, well, maybe not always by the full amount of the dividend, that there is some information in there, depending on if it opens down by more than the dividend or by less than the dividend, we can pull some information out of there. But for our purposes here, all we have to know is if the stock closed at $10 the day before, and if the dividend is 50 cents, the next morning that stock will just show a print of, I put 9.50 as in the time there, will just show a print of 9.50 on the open. That will be the next morning when you look at what the closing prices are. You say, I thought it closed at 10, but the print will show you that it closed at 9.50 because during the night, the dividend came out of the price and it just would open at 9.50, which means if it ended the day at 9.75, rather than your stock reports saying that the stock was down 25 cents for the day, it'll tell you that the stock was up 25 cents for the day. Even though it closed at 10 the day before and closed at 9.75 today, it should have opened at 9.50. So that ex-dividend date, you have to be prepared that the stocks will open. They will print at the reduced price of the dividend. Explain and describe. There's our keywords there. Explain the rationale for using present value models to value equity, and describe the dividend discount and the free cash flow to equity models. All right, well, let's start off with why we save money. Well, we save today to have more tomorrow. So to use the vocabulary of an economist, we defer consumption today in order to have future benefits. Well, these future benefits, the present value of these future benefits must be the value today. And that's why we use present value, because if we're deferring consumption for some future benefits, we want to know if it's worth it. We know what we're deferring today. We're going to take $1,000 and defer it for some future benefits. Well, what are those future benefits worth today? And that's why we would use a present value, would discount it at some required rate of return to figure out, is it worth it? So if we have a required rate of return of 10%, and we're deferring consumption of $1,000 for 10 years and we're only going to get $1,050, if we present value that $1,050, we'll find out, hey, buddy, don't do it. It's not worth it. That is the motivation or the rationale for using present value models, is to figure out if it was worth taking the investment and deferring consumption. Was the future benefit worth the deference? The simplest type of present value model is the dividend discount model, DDM. And every first-year finance student has seen the dividend discount model. And here it is right here, nice and simple. The value today, whenever we see a sub-naught like that, a zero, that means today, like right this minute. The value today is, and we have a summation series, the sum from the time equals 1. So if we draw our timeline, this is V0, this is what we're figuring out today, this is T1. So in other words, the first cash flow is in 1 year. So our dividend at time T, our dividend at time 1, discounted back by 1 plus the required rate of return for 1, plus 2, plus 3, plus 4, and on and on and on. So we have our terminology here. V0 is the value of the share today. DT is the expected dividend in year T. R is the required rate of return. And we should say something about the required rate of return. We're going to see more of it in corporate finance, but let's talk about it now. R is usually estimated using CAPM, the capital asset pricing model. Now, it doesn't say always, it says usually. In a little bit, I'm going to show you two other ways that you'd come up with a required rate of return, but it's usually estimated using CAPM, which is, and the logic here is quite simple, you got to give me at least the risk-free rate because that's what I can get. Plus, I'm going to want some risk premium. And what's the risk premium? Well, RE is the return on equities minus RF, which is the risk-free rate. In other words, this is the excess return for holding the market, the excess return above the risk-free rate. So I want the risk-free rate and I want the excess return on the market. But the stock I'm holding may be less risky or more risky than the market. That's measured by beta. So it'd be the risk-free rate times the excess market on the return, right-sized for the stock that I'm holding, the equity that I'm holding, and there's the beta. And that will give you R. You're going to see more of this in corporate finance, so I thought I'd just throw it out right now. If you've been through the corporate finance readings, well, then you recognize this. And remember now, I say usually, not always. All right, so this looks like a pretty ugly screen to go through, but it's actually, I'm really just trying to make one point, and the point I'm making is at the very top. This is our dividend discount model. And you can see that the value that we arrive at today is the sum from t equals 1 to infinity of all the future dividends discounted at a required rate of return. Why are we using infinity? We're never going to hold it to infinity. A common stock is perpetual. Yes, it has no maturity date, not like a bond where there's a maturity date and we get back the maturity value. We get back nothing. So that's why we use infinity in that sense, but let's think about that for a minute. Well, what if I'm only going to hold it for 3 years? Would I still use this to figure out the price today if I only want to hold it for 3 years? Yes. Well, what if I want to hold it only for 1 year? Would this still be a valid model using infinity? Yes, and I'm going to show you why. Let's say that we do only want to hold it for 1 year. What are we going to get? We're going to get one dividend, so we're going to discount that back one period, 1 plus R. But we're also going to get the selling price of the share, which is the price of the share at the end of period T. So if T is 1 year, then we get the price at P1, discounted back for 1 year. But how do we get P1? Well, if we have to figure out what PT is, which is P1, PT, we would say, well, what is going to be the dividend 1 year out? Discount that back for 1 year, plus we'll get the price. Now we're at PT plus 1. Well, how do we get that? Well, look down here. PT plus 1 is the dividend 1 year out from there, discounted back for 1 year, plus the price at the end of that year. Well, how do we get the price at the end of that year? And on and on and on. So if we go from a holding period of T equals 1 to a holding period of T equals 2, there's our first year dividend, discounted 1 year, our second year dividend, discounted by 2 years, plus the price we receive at the end of the second year, discounted back 2 years. If we go to 3-year holding period, here we are again, first year dividend, second year dividend, third year dividend, plus the price at the end of year 3. You can see that if we go to 4 to 5 to 6 to 7, etc., we would just keep extending this on. We explicitly discount 3 years of dividends, and wrapped up in the price is the implicit discounting of all the other future dividends. Hence, infinity. It's just the price captures the rest, whatever that price is. So that for a given holding period N, let's say that our holding period is N, we would explicitly discount the dividend for N periods, and then we would discount the price N periods from now backwards to today to the power of N. This last part is called the terminal stock value or the terminal value, and that is an N period holding period discount. Now wrapped up in PN is all future dividends discounted back to PN. So infinity. So this screen really was just saying, is infinity valid for all discounting, even if I'm going to only hold it for 2 years? And the answer is yes. So let's do an example just so that we're clear. Let's say we're going to hold an equity for 3 years. We're going to receive 3 dividends, and we have an estimated price at the end of year 3. We'll get $2 in year 1, $2.10, and $2.20. And we estimate that at the end of year 3, we should be able to sell the equity for $20. Our required rate of return is 10%. Find the value today. So the value today is made up of basically 2 components: an explicit dividend discount portion and an implicit dividend discount portion. So explicitly, we have $2 discounted by 10% for 1 period, plus we have $2.10 discounted by 10% for 2 periods, and we have $2.20 discounted back by 10% for 3 periods. There's the explicit discounting of the dividend. Implicitly in the price of $20 is wrapped up all the future dividends beyond that. So we're going to get $20 for the equity, and we're going to discount that back 3 years because that's at the end of 3 years, which will give us 1.818 for the first term, 1.736 for the second term, 1.653 for the third, and 15,026 for a total of $20.23 today. So this is very important. The value today depends directly on dividends expected to be received and indirectly on the dividends subsequent to the end of the holding period, and these dividends subsequent to the end of the holding period are wrapped up in the price we expect to receive, because how do we arrive at that price? That price must be all the future dividends discounted back to that date. All right, let's do another example, but we'll get a little messier here. This time there's certain things we're going to have to figure out along the way. Let's say that our dividend today at time 0, right today, is $4. Our growth rate is 20%, and that's the expected growth rate in the dividend for 1 year. It's only the expected growth rate for 1 year. The risk-free rate is running 6%. The return on equities is 11%, and the beta for this particular stock is 1.2. We estimate the price at the end of year 1 to be $15.40. What is the value today? And whenever we get really complicated stuff like this, now this is easy, really. This is not complicated. But the real world is messy, and it throws hundreds of things at you. And you got a lot of information, and you got to look at this mess, and you got to pick out what you need. Trust the formula. Trust the formula. So what is V0? Well, this is a 1-year holding period. So our value today is going to be the dividend at the end of the first year, discounted back by the required rate of return, plus whatever the price is at the end of that period, discounted back 1 plus R, and in this case, T equals 1. All right. So all we need to do is find these elements. Do we have DT? Well, we're given D0. That's all. We're given the dividend today. We need the dividend 1 year from now, but we're told the growth rate. So we can figure out what DT is, because it is the dividend today, 1 plus G, 1 plus the growth rate. So we have $4 today, and we have 1.2 in brackets here, which give us $4.80. So we're in a position to put in $4.80 over 1 plus R. Do we have R? Well, we do not have R. But remember now, R can be calculated using CAPM. So R will be equal to the risk-free rate plus beta. We have the return on equities minus the risk-free rate, because we're just looking for the excess return on the market, right-sized for the stock we have. That's why we multiply it by beta. Do we have a risk-free rate? We do, 0.06. Plus, do we have a beta? We have 1.2. Do we have the return on equities? 0.11 minus 0.06 in brackets. We will get 0.06 plus 1.2, 0.05 in brackets. That'll give us 0.06 plus 0.06, which gives us 0.12. So now we have 1 plus R is 1.12. Do we have our price in 1 year? We're told is 1540. Typically, we'll have to calculate that. Typically, we won't know that. We'll have to figure that out. That gets a little bit more tricky. I'll show you how to do that a little later on. And we do this 1.12. This will give us $4.29 on the dividend plus $13.75 on the equity. We get 1804. 1804. So we've done the dividend discount model. Well, we briefly looked at it. We're going to revisit it again, but I've introduced it. That's all we're doing in LOSC is introducing it. Let's look at the second one, which is the free cash flow to equity. And why would we use free cash flow to equity instead of a dividend? This is our numerator now. We're still going to use a present value model. This is still a present value model, but instead of our numerator being the expected dividend, it's going to be the free cash flow to equity. It reflects dividend paying capacity, because what do we pay dividends out of? Well, we pay not just net income, but you need free cash flow to equity to pay dividends. This is cash available to pay. So we're going to discount back the dividend paying capacity and not just the dividend. This is very useful for non-dividend paying stocks. It's also useful for companies that have really great reinvestment opportunities, whose dividend is low. It's a token dividend. There might be a 1% or a 1.5% yield. And you look at the prospects of the company and you say, you know what? The dividend is not reflective of the true value of the company. The dividend is a token amount that's returned to shareholders, maybe under pressure of some of the larger mutual fund holders that say, look, you got to provide an income stream somewhere. But the true value is in the reinvestment, and that's what we want to see. So in a case like that, you would look at the dividend and say, okay, the dividend is not reflective of the value of this company, or it doesn't have a dividend. You would use dividend capacity instead to value the equity. So free cash flow to equity, what is this? You've seen this in FRA, in financial reporting and analysis. It is our cash flow from operations less any reinvestment we have to make in CapEx. Otherwise, the earnings potential of the company will suffer if you don't keep reinvesting or replacing at least the basic asset base you have. So, cash flow from operations, whatever cash flow we have from operations, we would say, okay, our CapEx is not available to equity. However, any net borrowings are. Net borrowings means, okay, let's say we pay back $1 million, but we borrow $2 million. We got an extra $1 million. Well, we can distribute that to equity. Companies borrow at really low rates quite a lot to buy back stock because it's the best return they're going to get for their money. They do that. So we can include net borrowings. So it's cash flow from operations minus our CapEx plus our net borrowings. And all we do is it's the same formula we had, but instead of DT in the numerator, it's free cash flow to equity sub T. So D is just replaced by FCFE. That's all. Now, earlier I said that we usually, I use the word usually and I underline it, find R by using cap M. And here is cap M here. Well, we don't always have to use cap M. We might just find it in this particular way where we find R as the risk-free rate plus some risk premium. Just some risk premium that we use economic judgment for. We might look at one sector and say, well, we want 11% here, but 9% there, 7% there. It might just be broad premiums per sector that we want. Rather than calculating any betas, we might use that. And for the risk-free rate, we typically use a government bond, and we'll learn this in corporate finance more. We try to match the risk-free rate with the length of our holding period. So if our holding period is 5 years, we would not use a 90-day risk-free rate here. We would use the return on the 5-year government bond, not the 10, but the 5. We want to be on the same part of the curve as our holding period. Other times we might just say, well, look, I'm buying the company's equity. I know what kind of risk premium I want on the equity over the company's debt. So we might just take the company's bond yield as risk-free rate, because we might say, look, I can always buy the company's debt. And the company's debt will already have a risk-free price factored into it, plus a whole bunch of premiums for credit risk, for inflation, etc., for all those things. So I might just start at the company's bond yield and add a premium for the company's risk. Because my rationale is, look, I can always just get the company's bond yield, right? And inside the bond yield is the risk-free rate anyways. So you can arrive at R in a number of ways. You don't have to stick with CAPM. So let's throw 3 more questions at you. One of them's tricky. So let's look at the first one. An investor expects a share to pay dividends of $3 and $3.15 at the end of years 1 and 2, respectively. At the end of the second year, the investor expects the shares to trade at $40. The required rate of return on the shares is 8%. If the investor's forecasts are accurate, now, whenever you get a question like this, you have to just take it as gospel. If the investor's shares are accurate, so we're not even going to question them, they're accurate, period. So if there's an answer that relies on us saying that they're not accurate, or our model is, or we're confused about our model, we must reject it, because we're being told explicitly in the question, don't question it. They are accurate. If they are accurate and the market price of the shares is currently $30, the most likely conclusion is that the shares are over, under, or fairly valued. Well, you know what? Anybody can eyeball this and say, well, if I'm going to get 3 at the end of year 1, 3.15 at the end of year 2, plus another 40, if I discount that at the back at 8, I'm going to be over $30. This clearly looks like the share prices are undervalued, but if you want to do it very quickly, it would be 3 discounted back by 1.08 plus 3.15 discounted back at 1.08 squared, plus the $40 discounted at 1.08 squared, and you can combine this into one term of 43.15. So you can calculate that backwards if you want, but I think that's a lot of extra keystrokes, and just judging by this, if we're at $30, it's so far under, I can say it's undervalued right away, and if you calculate this back, you'll get to like 39 and change, so undervalued. But if you want to be sure, keep in mind, you got 90 seconds. 90 seconds per question. 90 seconds per question. And here's the deal. This question is worth 1 point. This question is worth 1 point. This question is worth 1 point. They're all worth the same. There's no sense spending 4 minutes on a question or extra time on a question when the next one is worth exactly the same amount of points. Now, if this were closer, if it said the shares are currently at $38 and I looked at this and said, I'm going to have to calculate that. But this, I could eyeball that. Being that you have enough, when you get enough experience with discounting prices, you could look at this, $3, $3.15, and 40 at 8%. Oh, there's no way that's going to get down to 30. You just kind of know, right? Next one, tricky. 2 investors with different holding periods, but the same expectations and the same required rates of return for a company are estimating the intrinsic value of a common share of the company. The investor with the shorter holding period will most likely estimate a lower, higher, or similar. It will be similar. That's why I took the time to show you that infinity is the proper symbol to use, is the proper time length to use, because even if you used a 1 period time length, D1 over 1 plus R, plus P1 over 1 plus R, wrapped up in P1 is all future dividends. Wrapped up in P2 are all future dividends, on and on and on, ad infinitum. So if somebody were using a 1-year holding period versus a 2-year holding period, they would still be doing all the dividends forever. And it says specifically, the same expectations and the same required rates of return. So if it's the same, no matter what their holding period is, they should get the same value today. Similar intrinsic values. Now that one's tricky, and that's why I took the time on that screen to explain why infinity is the appropriate one to use. And it doesn't matter whether your holding period is 2, 3, 4, 5 years. If you're using the same data, you'll get the same value today. There we go. An equity valuation model that focuses on expected dividends rather than the capacity to pay dividends is we've already talked about that. It has it right in the word, dividend. I shouldn't cover up the word. It has it right in the word, dividend discount model. Calculate the intrinsic value of a non-callable, non-convertible preferred stock. So we're going to take a little bit of a detour away from common into preferred right now. But when we get back to E and F, we're going to get back to the present value models for equities, for common stock. But let's just have a look at this preferred share right now. This couldn't be easier. If you've been through fixed income, there's not a lot new here. So we're going to talk about non-callable, non-convertible. And the reason we're going to start there is because it's the closest thing to a common share. Why? Because it's perpetual. I don't say it is a common. It's the closest thing to what a common share would look like because it is perpetual. So what do we have here? Well, what do we get? Recall on the dividend is stated as a fixed yield, right? So the value today is our dividend discounted by R. Why are we doing this? You have to go back to our quantitative analysis reading and say, well, if I'm holding a perpetual preferred share that pays a fixed dividend, I have a perpetuity, don't I? It says right in there, perpetual. It's a perpetuity. Non-callable, non-convertible, and the dividend stated as a fixed yield. I got a perpetuity. The present value of a perpetuity simplifies to the dividend today divided by the discount rate, R. That's it. So if we take a $100 par value at 5.5% and our R is 0.6, calculate V0. That should be easy enough, right? We just trust the formula. V0 equals, what's our dividend today? Well, the yield is 5.5. The par value is 100. Much like you'd calculate the coupon on a bond, it's going to be 550. And what is our R? 0.06. And once we calculate, once we calculate that, I just got to find my sheet, 9167. 9167. So we would be paying 9167. Now, just as we did in fixed income, we can ask ourselves, does that make sense? It's yielding 5.5. The market wants 6. So this is going to be a discount. It's a $100 par value. We're getting at 9167. This is a perpetuity, 9167. What if it matures at time N instead? What if it matures at time N? Guess what? You got a bond. If it matures at time N, you've got a bond. You can use this formula to figure it out, where we have an explicit dividend discount period, and then we discount the future value. But because the dividend is fixed each year, you can think about it as a series of coupon payments with future value. Because this is a preferred share, it has a par value with a par value. So let's take a $20 par value at 6%, paying interest, dividends semi-annually, maturing in 6 years with a discount rate of 8%. Well, let's solve it like a bond. Let's forget about the formula right now. This is a bond. And what do we need? We need 4 of 5 different variables. And if you look at your calculator on the second row, you got all your variables right there. We need a future value, 20. We need a payment, PMT. Well, it's a 6%. Well, what's 6% of 20? And since it's semi, it pays semi-annually. It's $1.20. 6% of 20 is $1.20. So every dividend payment is going to be 60 cents. We need an N, a period of N. It's 6 years, but it's a semi-annual, so our N will be 12. And we're going to need the discount rate. And we're told that it's 8, but since we're doing it semi-annually, We enter 4. Hit CPT on the computer, compute PV, and you will get $18.12. You can solve that just like a bond because it is a bond. It has a known future value, par. It has a fixed dividend. It has a stated periodicity. Typically, they'd be quarterly, not semi-annually. Typically, they'd be quarterly. You got to watch for that. And it tells us that it matures. So we can solve this just like a bond. If we don't solve it like a bond, guess what? It's a perpetuity. So for preferred shares, that's rather kind of simple. So let's do another example here. Here's a non-callable, non-convertible perpetual. So that's a perpetuity, right? We have a par value of 100 at 475. The credit rating on the company is BA1/BB, and at this credit rating, the required return is 7.5. So on this particular case, how did we arrive at the required return? We have a quasi-fixed income security, so we're just going to look at the credit rating and take a required rate of return suitable to that credit rating, just like we would do on a bond. So what is the intrinsic value of this? Well, it is a perpetuity. So all we have to do is find our current yield divided by the required rate of return. It's a 4.75 par value 100, so it's 475. We're assuming annual. And we know that the required rate of return on this credit rating is 7.5 divided by 0.075 will give us $63.33. There we go. Does that make sense? Well, it pays 475, but the market wants 7.5. So it's going to be discounted, and since look at the spread between 300 basis points, it's going to be heavily discounted. Par value 100 you get for 63.33. If you know how to buy and sell bonds, if you know how to price bonds, you know how to deal with perpetual preferred shares, you know how to deal with almost all preferred shares. Here's where it gets a little bit tricky. What if the shares were callable? What if they were still non-convertible, but they were callable? Well, you got to think, if they're callable, they'll only be called when it's in the company's best interest to do it. So it has value for the company. It has value for the company. So would I be willing to pay $63.33 in that instance? Well, no, I'd want to be compensated a little bit more because it has value for the company. I'm going to be able to buy this cheaper than $63.33 because the discount rate will be slightly higher on that because it's riskier. It'll be called back precisely when it's in my favor to own it. So that would be lower. Now, we don't bother with that. We don't worry about valuing embedded options at this level. So just know the relationship that if it were callable, whose benefit is that? That's the company's benefit. So I'm going to want to be compensated over here. Let's look at a retractable term preferred share, a retractable term. A par value of 25, pays 5% quarterly, retractable in 34 quarters or 8.5 years at par. And the required rate of return on this is 15.5%. It's retractable at par, which is $25. So if you recall what extendable and retractable bonds were, we talked about extendable bonds where we can hold a short 5-year bond or 10-year bond and at our discretion extend it out for a longer period of time. Or we could buy a longer-term fixed income security and elect to cash it in sooner. We can retract the term. So this is a preferred share that is probably a perpetual preferred, but there's a retractable date that by a certain date, if we say, you know what, we don't want to hold these anymore, just give us par back, we can exercise our retraction and put them back to the company. After the date, maybe the retraction disappears and they become just regular perpetual preferreds, right? But the retractable date is in play. It's still out there. What would be the value of this? Well, this is a bond, isn't it? Because we have a term, we have par that we're going to get, we know our required rate of return, and we have a coupon. So what is our future value on this one? It's $25. What is our N? Well, we're going to figure out quarterly. what our payment is quarterly, so we want our N to be in the same periodicity, quarters, and we're told 34 quarters, so our N is 34. Our PMT is going to be what? It is going to be $25, which is the par value, times 5% divided by 4, because we have a periodicity of 4, which will give us 0.3125. And our IY for the calculator will be 15.5 divided by 4 to put it in the same periodicity, which will be 3.875. And we simply compute PV. We will get $12.71. Calculate and interpret the intrinsic value of an equity security based on the Gordon Growth Dividend Discount Model or a two-stage dividend discount model as appropriate. We're still using the same model. This is still a present value model. It's still a dividend discount model, but the Gordon Growth Model allows for growth or change of the dividend over time. It assumes dividends grow indefinitely at a constant rate. That is not always a good assumption to make, which is why we have what are called two-stage and three-stage dividend discount models. But it's fairly okay to keep for now if we're going to look at non-cyclical mature companies. That's not an unreasonable assumption. Non-cyclical mature companies. So what does it look like? Here it is right here. It's basically what we had before, except the numerator now has just an extra item in here, 1 plus G. So we're taking the dividend today and multiplying it by 1 plus G. What will that give us? That'll give us the dividend 1 period from now. So the Gordon Growth Model starts with the dividend 1 period from now, discounted by 1 plus R, and again, infinity on the top. So if we were to expand this out, what would it look like? Well, we'd have D naught. That would be the common term all the way through. So why don't we just take that out and in the brackets put the rest. 1 plus G over 1 plus R. So if T is 1, that's what it would look like. Then T goes to 2, 3, 4, 5, all the way to infinity. And in this series, R is strictly greater than G. That is a huge deal that you got to pay attention to. R is strictly greater than G. If it's not, this doesn't work. As R approaches G, this starts to give you garbage. So I'm going to talk more about that a little bit later on, but we're making the assumption not just that R is greater than G, but R is strictly greater than G. Again, I'll expand on that later on. Well, if we make that case, look what happens here. If R is strictly greater than G, we have 1 plus G over 1 plus R. So this is going to be less than 1, isn't it? 1 plus G over 1 plus R, because R is greater. So this will be less than 1. Well, if we square it, it becomes even more less than 1. So as we keep going out into infinity, these final terms almost become 0. So this is called an infinite geometric series. And it sums to 1 plus G over here over R minus G. Now don't ask me to derive it mathematically. Just take my word for it that everything in brackets sums to this. So we've put D naught on the outside of the brackets, and this is what the inside sums to. So we can move that back over here, and we can get rid of the summation sign, because this summation sign was everything in here, and everything in here simplifies to this. So now the value today is the dividend today multiplied by 1 plus G, because it's 1 plus G here, over R minus G, which is our denominator. Well, the dividend today, 1 plus G, is just the dividend 1 year from now. So this is really nice and simple. The Gordon Growth Model, the value of an equity today is the dividend in 1 period divided by R minus G. Boom. Now, R is strictly greater than G. R must be greater than G. Look what happens if it's not. Let's say that G is greater. You end up with a negative denominator, a positive numerator, you'd get a negative price. So the Gordon growth model would spit out garbage as soon as G got greater than R. In fact, it spits out garbage the closer R gets to G while still being greater than G, and I hope to show you that shortly. So let's do a little example here, and here's our example. Let's say the dividend today is on an equity is $5. We have a growth rate in the dividend of 4%, and our required rate of return is 8%. By the way, our G, I should have been more explicit on G, that's the growth rate in the dividend. That's not the growth rate of the company or the growth rate of anything. That's the growth rate in the dividend. And our required rate of return is 8%. This is what the model looks like. It's just the dividend today, 1 plus G over R minus G. This basically is the present value of a growing perpetuity. That's all that is. If you go back to time value of money, this is the present value of a growing perpetuity. So D naught, our dividend today is $5. Our growth rate is 1.04 or 4%, so 1.04 over. Our R is 0.08 minus our G is 0.04, so it's only the difference we're interested in. We would get $130 per share. Well, what if the growth rate in dividends were 0? This is just to show you something interesting here. If the growth rate in dividends were 0, this would be 1 plus 0 is 1. The numerator would just be D naught. This would be R minus 0, which is R. It would be D naught over R. And what is this? This is the present value of a perpetuity. So we can have the present value of a perpetuity or the present value of a growing perpetuity. This we saw back in quantitative analysis, which is why earlier I said in one of the videos, the proper course to study with is to start with quantitative analysis, because that filters through to fixed income, it filters through to FRA, it filters through to equity valuation, to corporate finance. You start there because that forms the base of a lot of different topics that we're doing. So you should recognize this as a growing perpetuity and a perpetuity. Okay, so how do we get G? How do we get this growth rate? Because every time we throw a variable out, it has to be found in the real world. Sure, I'm giving it to you right here. How do we get G? A smart-ass student would say, well, I just look up on the top of the screen and I find it right there. Ha ha. But how do we get it? In the real world, how would we get it? G gives us, to get a sort of a growth rate in dividends, we have to know, well, what is the company capable of doing? We don't want to choose a G that they're not capable of performing. So we can use this little thing down here, B times ROE, where B is the earnings retention rate, 1 minus the dividend payout ratio. If that's our dividend payout ratio, 1 minus it is our retention rate. So it is our retention rate multiplied by our return on equity. That would be the potential growth rate in dividends that we could use, because we can't include what we're already paying out. So that would give us a potential for the growth rate, and as long as our G comes in lower than this, we're okay. We're okay. So the G would be the analyst's estimate of what they think it would be. And not only that, I'm going to show you how you can get G from historical dividends. So this is a rather detailed question, a lot of moving parts here, so we'll take our time with this. Here are 5 years of specific data. Our earnings per share, 376 grew to 620 over 5 years. Our dividends per share, 135 all the way to 228. We have a payout ratio in each of the years, fairly constant payout ratio, right around the low to mid 30%. Our return on equity is fairly constant, around the low to mid 30%. And we have a share price, 39, 52, 54, 56, 38. Remember, going into 2008 was a pretty ugly year. There we go. So if we wanted to calculate an intrinsic value for this as of the end of 2008, we want to say, what do we think about that 38.91? Does that make any sense? And we want a required rate of return of 19%. Well, how would we start something like this? Well, you have to trust the model. You have to trust the model that we have. And what model do we have? we're looking at a price today, and we see that we have growing dividends, so we'll use the Gordon growth model, which is our dividend today, 1 plus a growth rate divided by R minus G. There we go. We got to find all of these variables. Do we have D naught? Yes, we do. In 2008, our D naught is 228. We remember now, we're checking to see if this is the right price. That's the whole purpose of analysis, is this over or undervalued or fairly valued? So we'll start with our D naught. Well, we know our D naught, in this case, is $2.28. Great. We're told our R is 19%, so R is 0.19. So we have this, we need G. G equals what? Well, that's easy enough to figure out, really. Look at the progression we have in our dividends. They have grown. So how do we figure out what the growth rate was? Well, we end with 228, right? We have $2.28. So that must have equaled, we started with 135, 1 plus G to the 4. If we assume G is the growth rate in this dividend, that's all it is, because we multiply 135 by 1 plus G, we multiply that by 1 plus G, that by 1 plus G, that by 1 plus G, we should get to 228. And all we have to do is solve for 4, and that's easy enough. Divide both sides by $1.35. Take the fourth root of each side, and then subtract 1 to isolate G. And you will get G equal to 0.14. So over the years 2004 to 2008, the growth rate, the compounded constant growth rate, based on how we figured it out here, was 14%. Okay, so let's do that. Let's have a look at what we would have. So our value today is our D naught, 228, 1 plus our growth rate, divided by our R minus our G. And that will give us 51.98. So we've taken some messy information and we've combined some skills that we've gotten from a number of different study sessions so far. We're at 51.98. So the share price is $38.91. We're at $51.98. So we can make a conclusion, because this is the ultimate goal of what we're doing. Share price of $38.91, undervalued. We're making that assumption based on what we've looked at in the growth rate of dividends. We're saying that looks undervalued. If G equals 0, let's say that going forward G equals 0, what do we have? We would have a value today of a perpetuity, 228. We would have 0 growth in our dividend. 228 divided by R, 0.19, would equal $12. Now I'm going to make a point here. It would equal $12 if G were 0. G is 14%. The dividend is growing at 14%. Look at what that does. It turns a $12 intrinsic value stock into a $51 or $52 stock. Therefore, the growth, that 14% growth in the dividend, G adds value. And in this case, G added $39.98 to V0, to the value today. So, what is the value of a growing dividend? Significant. The model is very sensitive to the value of a growing dividend. So the faster the rate at which the dividend grows, the higher the valuation will be today, because it doesn't change the denominator, but the numerator will get larger and larger and larger and larger as we go on. So if we had no growth, it's worth $12. If it's only going to pay $2.28 and we need 19%, 19 required rate of return, $12. But because the dividend is growing at 14%, suddenly it's got a lot of value. So you can start thinking about that in terms of how a company approaches its dividend policy and how it approaches it in terms of delivering value to shareholders. Every extra point of G it can deliver has huge value for shareholders. Huge value. You want to identify those companies that have a nice G and will defend that G. That's beautiful, right? Let's play with that G a little bit more. If G equals 13%, what do we get? Well, we would have a value of 228 at 1.13. We're just giving up 1 point of G here. We're just giving up 1 point. I want to show you something here. 228 to 0.19 minus 0.13. Notice that our denominator got wider. It got bigger. We're not dividing now by 0.05. We're dividing now by 0.06. And our numerator is growing at a slower rate, $42.94. From $51.98 to $42.94 by giving up 1 point of G. Look how critical that is. Now, if G equals 13% and R, we were off by 1%. R is actually 20% instead of 19%. Our V0 now turns into 228 times 1.13 divided by 0.2 minus 0.13. We're now down to 3681. The model is very sensitive to R and to G. So if we continually get values that are greater than the market value all the time or lower than the market value all the time, we would begin to question our use of R and our use of G, because look at the range that we've achieved just with 1 point moves, going from 0.14 to 0.13. We've taken basically $9 off the price of the stock. That's about an 19% drop in price for 1 point of growth in the dividend. Crazy stuff, eh? So let's have a look at a little bit more of that sensitivity. Okay, so let's. I'm going to show you the sensitivity to prices with R and G, and I'm going to show you that issue about R getting too close to G. And first of all, let me fix something. Notice down here it says R equals 10%. That should be a 9. Change that to a 9. Okay, so there we go. So let's start at the bottom row here, and we'll look at our growth rates being 2%, 5, 8, 11, and 14. And G at 14 and R at 19. This is the scenario we did on the last example. We got to 51.98. So we can see that as G drops from 14 to 11 to 8 to 5 to 2, the share price drops significantly. So a company whose growth rate and its dividend is dropping over time would notice a drop in share price based on what this model is telling us. If our required rate of return drops all the way through, the share price should increase. The share price should increase because the required rate of return is dropping. The share price should increase. Look what happens here. Here's R at 7. Here is G at 5. $119. R at 10, G at 8, 123. R at 13, G at 11, 126. R at 16, G at 14, 129. In fact, if you had an R of 15.9 and a G of let's say 15.8, R is still greater than G, but you would get a ridiculous price. You'd get a price for this stock in the thousands, if not the hundreds of thousands. The closer R and G get together, the more you get this kind of thing going on. You get garbage, which is why we use the word strictly. R is strictly greater than G. R is strictly. Most required rates of return on equities will be in the 8 to 15% range. Over looking at historical returns on equities in the 8 to 15% range. Growth rates typically would be lower than that. What happens if you have a growth rate higher than that, though? What happens if you realistically have a company with a 20% growth rate in its dividend, and it's in a safe area, or considered a safe equity, stable earnings, been around a long time, and you decide that the required rate of return is 10, that you have a legitimately honest required rate of return of 10, but the growth rate in the dividend is 20. Well, you can't use the Gordon growth model. Simple as that. You simply can't use it. It'll give you garbage. You would have to use some other method to calculate that. And typically you'd use a multiple. You'd say, well, okay, the dividend discount models are just probably going to give me garbage on this, so I'll move over to one of the multiples. Our point on this screen here is the model is extremely sensitive to changes in both R and G. So if you're having trouble with your output, if your output is telling you you've got a very biased or inefficient market, it's maybe one of your two inputs. And as R approaches G, the price will increase dramatically, hence the requirement that G must be strictly less than R, or what I said earlier, R is strictly greater than G. Must be strictly. Strictly means really less than, significantly less than. Look at, even when it gets 2%, our G of 8 and an R of 10, we're at $123 for the stock. It starts to throw out this garbage at you. So it's one of those models to say, look, what is it good for? It's good for very stable, low growth companies that are known as an income stock, that have a dividend that grows at a specific rate, but not a great rate, but grows at a specific rate, where you're using a discount on the market that reflects the general market as a whole, as opposed to any one thing, maybe a beta of 1 on that one. And that tends to work very nicely, but you're getting stocks that are looking more and more like perpetuities, like growing perpetuities. There's your Gordon growth model. Beyond that, you have to move away from that. So it should be pretty obvious now, but we'll go through some of the assumptions, and we'll look at some of the alternatives. So some of the assumptions of the Gordon growth model: dividends are the correct metric for valuation purpose, because that's what the numerator has, dividends, not free cash flow to equity, but dividends. So dividends are the correct metric. G is forever, perpetual, and never changes. That's usually the unrealistic assumption. R is also constant over time. Well, that's also somewhat realistic. More, I would say, between G being forever and R being forever, constant, the same number forever, I'd say G is the more unrealistic one. R is closer. You could almost accept that as a premium on equities, almost, but no, it does change. And G is strictly less than R. If you feel you cannot use the Gordon growth model, if you feel that what you're doing doesn't quite fit, there are alternatives. Number one, you can modify the model for varying patterns of growth. And that's what we're going to do. We're going to look at a 2-stage and a 3-stage. Well, we won't look at the 3-stage, but I'll talk about the 3-stage briefly. But we'll look at a 2-stage Gordon growth model. You can modify the model. You can use a cash flow measure other than dividends. So if you got a problem with assumption number 1, use something other than dividends for non-dividend paying stocks. If you have significant problems with several of the assumptions, use some other approach. Simple as that. There are 3 categories of valuation models: present value, multiples, and asset-based. You don't have to stick with present value. If you find that for a particular equity, the assumptions just don't hold water, you don't like them, it doesn't. You're not getting the right answers, you're getting garbage out, move on, use some other approach. So to get us starting to think about modifying the model and to take a mental step closer to the 2-stage model, let's look at a particular problem. Let's look at a stock that doesn't pay a dividend right now, but we expect that it'll start paying a dividend 5 years from now. Don't ask me how we expect that. We expect it to start at $4. Again, don't ask me how you can get a $4 dividend 5 years from now today. That seems unrealistic, but this is not meant to look like the real world. This is just an example of how we would do it. It's just to show you the mechanics. So understand that this is a fabrication of reality. You'd never really come across this. So D5, we have a dividend of $1. We expect that the dividend at that point to continue to grow at 6%, and we have a discount rate, required rate of return of 10%. So whenever I have questions like this that span time, go back to time value of money in quantitative analysis. What did I tell you to do? Always draw your timeline so that you can tell your story. So what's our story here? Well, our story is that we're going to get a $4 dividend here. Here we're going to get $4 that grows at 6% on and on. We're told that our required rate of return is 10% in this particular case. We know our growth rate here is 6%. And it's going to start paying a dividend in year 5 onwards. And we have to find V0. What is the price? What is the value today of a stock that has these characteristics? Well, we can solve this in one of 2 ways. We can find V5, and V5 is simply D5, 1 plus G, because remember, it's always the dividend 1 year from now, 1 plus G, over R minus G. So we can solve that. What do we get? Well, we get $4 times 1.06 is our numerator. And on the denominator, we get 0.1 minus 0.06, which will give us $106. So it's got a value of $106 today. But notice we didn't include the 4. We started a year from now. We're still getting the $4. We're buying it today. In year 5, it'll pay a dividend of $4, but the model that we used 1 year hence. So what we have to do now is we have to discount back that $4 at 1.1 to the 5. But we also have to discount back the $106. The price at V5, the value at V5, we want to get it back today at 1.1 to the 5. So the dividend will give us 2.484, and the equity price will give us 65.818, which will be $68.30. There's one way to do it. Getting it back today. Now, this is one step closer to a two-stage model. What is our first stage? Our first stage is 0 dividends. What's our second stage? Constant growth. In the two-stage model, we're going to introduce dividends over here, but a different growth rate than dividends over here. I just wanted to show you how you would break it down this way first, so that when we get to the two-stage, it'll be obvious. Now, what is a better, more direct way to do this? Well, it would be simple. We could find the value today by saying, what is the value at period 4? Because then we could just, the $4 is the 1 year from now dividend, right? We could find the value at 4 and discount it back to the power of 4. But the value at 4 is really this, right? So it would be the dividend 1 year from now. Well, if we're at year 4, the dividend 1 year from now is $4. And we would discount that 0.1 by r minus g, 0.1 minus 0.06. There's our numerator, there's V4. Discount it back by 1 plus r to the power of 4, which is 1.1. You'll find that if you do that, you'll get 6830. So when we have a timeline, all you have to do is just find a point that you like. Let's say you bring everything back to year 5. We find the value for 5. Then you know you have to bring back a $4 cash flow plus the 106. But if we value it at V equals 4, we include the $4 dividend in because that is 1 year from now. And then we just have to discount that by 4 years. So when we understand how to use timelines, you'll understand that when we're moving money around on a timeline, there's more than one way to do it. All right, let's have a look at the multi-stage dividend discount model, and we'll look at a two-stage model. It makes use of 2 growth rates. It has a high growth rate for a short period of time, an initial finite period. So we'll refer to this one as GS. And we have a low growth rate. After the initial high growth rate is over, we'll have a low growth rate in the dividend into perpetuity. We'll call this the long-term growth rate. So we have a short-term growth rate that's going to be high. We'll have a leveling out of that growth rate followed by a long-term growth rate that's low. So the dividend will grow, and then at some point, the growth rate will change. That's what we're looking at. So that's a two-stage dividend discount model. Stage 1, Stage 2. Well, for Stage 2, we can find the value as of this point in time, call that Vn. Why? Because what have we got? We've got a Gordon growth model here, don't we? Low G, constant G, for a long period of time into perpetuity. We can use the Gordon growth model to estimate the price here. But we need a price here. Well, during this first period, we can use an explicit dividend discount model plus a terminal value. We can discount back all the dividends for this period of time plus the terminal value. What's the terminal value? Vn. How do we get Vn? It's the Gordon growth model for this. So the value today equals our explicit discounting of the dividends, sum t equals 1 to whatever period n, we're going to discount the dividends. Our dividend is D0, 1 plus our slow growth rate, T. Now, why are we going 1 plus G? Is because you don't discount anything today, you discount it 1 year out, right? So we'll start with the dividend today. This is 1 year from now. Divided by 1 plus R, of course, to the T. That is our explicit dividend discount model plus our terminal value. We're going to get VN for the stock, and we're going to discount that back by the same amount of periods. But VN is calculated over here, and we know that VN is the dividend 1 year from that date, DN plus 1, over R minus G, the long-term growth rate, as opposed to the short-term growth rate. We're still not done. We still got to figure out how we get DN plus 1. That is the dividend over here at the end of the first year. We only know the dividend way over here. How do we get that dividend? Well, that's easy enough. DN plus 1 will equal the dividend today that grows at the short-term growth rate, the high growth rate for n periods. And then, of course, we need that to be 1 period out. And there we go. So you can use a 2-stage model. You can easily see that you can use a 3-stage model by simply just pushing the Gordon growth model out to, so let's say we had an initial stage like this, then we had this, then we had that. Well, there's your VN. Then you have 2 explicit periods of discounting. So you'd first calculate VN, then you'd calculate this stage to get the value here because you have VN. Then you'd calculate this stage because then you'd have the value for this that you bring back. So you can see that you could use a 3-stage growth model as well. So you can modify the model if you have multiple different growth rates over time. Well, let's actually solve a problem because I think it looks better when we solve it. We're looking at an equity that as of today paid a dividend of $5. We have a short-term growth rate of 10% in the dividend per year for 3 years only. The long-term growth rate, GL, will then moderate down to 5% per annum subsequent to that. We have a required rate of return of 15%. What is the value today? Calculate the intrinsic value. Well, always put a timeline. It doesn't hurt to put a timeline and to tell your story on the timeline. That's all we want to do is tell our story on the timeline. So our short-term growth rate is 10% per annum for 3 years. So for the first 3 years, our G will equal 10%. And then after that, our G will equal 5%. What is going to be our dividend here is 5. We know that. What is our dividend going to be at D3? Because if we're going to use the Gordon growth model, we need our dividend here multiplied by 1 plus G. So our D3 is going to be 5. And what's the dividend going to grow at? 10%. And how many years does that have to grow at? 3. So we can calculate that there. So you can fill in a lot of information on this. So our R is 15%. So the way I approach this is I work backwards. Work at the last stage because you're going to need the terminal value of the stock here to calculate the first stage. So there's no point in writing out the first stage because you'll get to the point where you don't have a number for this variable. So always work backwards. So let's find what the value is at V3. For that, we can use a Gordon growth model, which is the dividend at D3, 1 year out, which is the dividend at D4. So we take the dividend for D3 multiplied by 1 plus 0.05 because it's a growth rate of 0.5. And we divided by R minus G. R is 0.15, G is 0.05. So that will give us $5 multiplied by 1.1 to the 3, because that's D3. See, we had to figure out D3, 1.1 to the 3, multiplied by 1.05, divided by 0.15 minus 0.05 will give us 69 0.8775. So there's V3. There's V3. So let's see where V3 fits in the grand scheme of things. Now we're going to deal with the first stage. Well, the first stage is an explicit discounting of the dividend plus a terminal value. We've already calculated the terminal value. So here our V0 is going to equal $5, which grows at 10%, because that's what's our dividend going to be at this period of time, because we got to discount that back. It's $5 today, grows at 10%, and we discounted by 1.15. There's the first dividend discounted. Then we have 5 that will grow at 10% for 2 years, discounted at 1.15 for 2 years. Then we have a dividend at year 3, which is 5, that grows at 1.1 for 3 years, discounted back by 1.15 to the 3, plus our terminal value. Our terminal value is our V3. Our V3 is 69.8775, 69.8775, discounted back by 1.15 to the 3, will give us 59.68. So, an equity that displays these characteristics, a current dividend of $5 that's going to grow at 10% for 3 years, after which it's going to grow at 5%, would be worth $59.68 today. Using a Gordon growth model, we can find the value at V3, which then becomes the terminal value for an explicit dividend discount model with a fixed period of time. All in one. Now, are you going to get something like that on the CFA that requires this much work? No, because you only have 90 seconds per question. So rely on that. Rely on the fact that you must be able to solve something within 90 seconds. Otherwise, it would be foolish to be asked. It wouldn't be asked. It wouldn't ask a whole bunch of questions that take 3-4 minutes to solve. They'd be 90-second questions. So you may be given a question like this and asked a specific thing about something, not to calculate, but ask some question in words, and you would, unless you knew how to calculate it, you wouldn't know how to interpret. Typically, when you look at learning objectives that have the word calculate, they will always, I shouldn't say always, they will most likely, 90 to 95% of the time, also come with the word interpret. You cannot interpret unless you can calculate. Unless you know how this was calculated, you couldn't interpret this. So it might ask you one component of this, but it certainly wouldn't give you this scenario and say solve the whole thing. Now, all bets off at level 2 and level 3 though. But at level 1, you would not get something this detailed in a question, but knowing how to do it means you know how to interpret anything they throw at you. Identify characteristics of companies for which the constant growth or the multi-stage dividend discount model is appropriate. And the book doesn't really make this explicit. It doesn't really sit down and say, okay, well, look, here's what it is. It's kind of peppered throughout the whole reading, and you have to sort of pull them out, so I did for you. Here's constant growth, and here's multi-stage DDM, and the types of characteristics of companies in which they'd be appropriate. Now, this setup, this screen here, I can think of a lot of really great CFA questions that I can ask based on different characteristics of companies. I can give a question saying a company that exhibits these types of characteristics most likely lends itself to valuation by constant growth, multi-stage. I'd ask something like that. I can easily see that. So, constant growth. Looking at a company with stable growth in its dividends, probably stable growth in its revenues as well. In the maturity phase, obviously, if you go back to the life cycle of companies, we know that when a company gets in the maturity phase, it exhibits stable growth over time. Non-cyclical, because we want that dividend to be constant and increasing. Dividend-paying company, obviously. And you also want G, which is the growth rate of the dividend, to be less than this. What is this? This is 1 minus the dividend payout ratio times ROE. We've already seen that earlier, but this is what you want. You want to make sure that that growth rate is sustainable. How do you make sure it's sustainable? By making sure that it's less than the capacity to grow at. Now we know it's sustainable. What's appropriate for a multi-stage dividend discount model? Well, more rapidly growing companies. We've already done the two-stage. We'll start at the bottom down here. Follow me, and then we'll work up. The two-stage DDM, dividend discount model, we looked at, where a company might be in a transition stage where it still has some high level of growth, and they're going to be moving into the maturity phase where that growth will moderate to a lower rate. So these are older companies out of the growth stage, in the transition stage, heading to maturity, or a revitalized company that might have been in the maturity stage, heading into a period of growth before it hits the next plateau of maturity. A three-stage DDM is more for a younger company just entering the growth stage, because you're going to have a big growth stage, you're going to have your transition stage, and then finally your maturity stage. So you would use a three-stage DDM. And remember now, if you don't like dividends, if you don't like to use the dividends, you can always use free cash flow to equity in that. So we would add more stages the younger the company is. As the company moves through the life cycle, you can keep reducing the stage until you get to maturity, stable growth, non-cyclicality. Then you'd have your constant growth model. So as long as you understand that the stages you would use drop as the company moves through its life cycle towards maturity, where it's just a single stage model, then I think you'll do fairly well on this. All right, let's see what we're doing here. Explain the rationale for using price multiples to value equity, how the price to earnings multiple relates to fundamentals. That's a kind of an interesting one. And the use of multiples based on comparables. We're going to see that that's fairly straightforward. The calculate and interpret come in here. Calculate and interpret the following multiples: price to earnings, price to an estimate of operating cash flow, price to sales, and price to book value. At the end of the last video, we do all of that there, but we'll do a little bit of that here. So, price multiples, what are they? They are ratios that compare the share price, so there's our numerator, whatever the price of the share is, with some sort of monetary flow or value. So it'll be the share price over earnings or sales or cash flow, that's a monetary flow, or some value, typically book value. So here are the common ones. Our PE ratio is the price divided by earnings per share. Price to book is the price divided by book value per share. All your denominators, by the way, are per share amounts. So your price to sales is price divided by sales per share, and price to cash flow is price divided by free cash flow per share. Sometimes it's operating cash flow per share. Now, here's where the use of multiples gets into a kind of a bit of a quagmire. For the, I don't want to say the uneducated, we'll say the untrained. For the untrained, they typically look at these ratios in terms of trailing numbers, and they don't understand that they're looking at trailing numbers and not forward numbers. For valuation purposes and as analysts, trailing numbers aren't that valuable. They're only okay, I think, for maybe stable, mature companies. But for growing companies, trailing numbers are quite useless, and I'm going to show you how actually useless they are. So the denominators may be based on trailing values or forward values. I think that we want to use forward values as often as possible because we buy the future. We don't buy the past, we buy the future. So let's explain the rationale behind some of these ratios. The price to earnings ratio, which is commonly just called the PE ratio. And here I'll talk about what's good about this stuff, why we would use it, and the kind of the drawbacks on each of the four. So PE, it's easy to use. It's easy to use because if we look at the income statement, we're given both basic earnings per share and diluted earnings per share, and we can look in the marketplace and find P-naught. The only calculation to do is actually just to divide the two. So that's easy to get to. It's the most common measure, that's quoted in terms of how expensive or inexpensive a stock is, not by its price, but by the multiple of earnings that you're going to pay for it. And it is strongly correlated to long-run returns or to long-term returns. The negative side of this is it's useless if earnings per share is less than zero. If earnings per share is less than zero, or worse, if earnings per share is zero, because now you have a denominator of zero. It's even useless if earnings per share are like a penny and the stock is $9. It's useless in that sense. It's also useless if earnings are volatile, because quarter to quarter you'll have a PE ratio that's extremely volatile. And in the end, it suffers from the usual cry that earnings are an accounting measure. Earnings can be heavily manipulated and heavily engineered. So the company that can manage earnings can also manage their PE ratio. Price to sales. What's good about that? It's not influenced by accounting choices. There's top-line revenue. It is a better metric also if earnings per share are less than zero, because sales will either be zero or some positive number. It won't be less than zero. The negative side to that, you have revenue recognition issues. They still apply. That's still an accounting choice, but that's not such a big thing. Here's the big thing. It ignores your cost structure. So it ignores two companies, one which may have high operating leverage and one which may have low operating leverage. That's a management choice. That's a strategic choice. So we don't want to right-size those companies for their cost structure, saying, well, what if they did have the same cost structure? They don't. That's the point. They don't have the same cost structure. So to say, well, what would one be if it had the same cost structure as the other, is to miss the point that they made a strategic decision not to, and one will be more successful because of the choice than not. Because we're not going to buy a what if they were like this scenario. We got to buy what are they right now. So it ignores that cost structure issue, because sales have nothing to do with your operating leverage. It doesn't. It has your profitability does, but not your sales. The third ratio we'll look at, the price to cash flow. What's good about that? Well, more of an economic measure. Cash flow, cash either shows up or it doesn't. It's much more difficult to manipulate this number. Not that you can't. Not that you still can't make choices, especially under IFRS. You've got a lot more flexibility to make choices about where you're going to put certain cash flows. More difficult to manipulate, but not impossible. Just more difficult to manipulate. Tends to be less volatile than earnings per share, and it is more reliable over the long term. And as a valuation mechanism, the price to cash flow is very popular within the industry. But for the average person on the street, typically they've heard of PE. For the untrained, I don't want to say the uneducated, but the untrained, or the financially illiterate, or the not so financially literate. How's that? We'll defer to PE, but those in the know tend to say put a lot more value in price to cash flow. The negatives, it ignores non-cash revenues. I don't really care. I don't see that as a big deal. If it's a non-cash revenue, I got to question the revenue. So, even though it's a negative, even though if you look around and you find what are the negatives to this, this will be one that's up there. It does ignore non-cash revenues because it doesn't show up as cash. I'm not so put out about that. Price to book value. What's good about this? More stable measure. Book value doesn't change that often. Can be used even if earnings per share is less than zero, and is appropriate. It is appropriate for firms in distress. However, it ignores relative asset size in comparisons, if we're comparing cross-sectionally, and the book value does not necessarily mean market value. So if you have a company that's loaded with intangibles, most of their asset value is in the intangibles, the book value and the market value may not be identical in that respect. Well, I shouldn't say may not be identical. It won't be identical. So you might not be getting a true value of the company. For instance, have a look at Apple's price to book. Their book value per share is extremely low compared to what their market value per share is. So clearly their price to book will be completely different than what it would be if you valued their net assets at market, or what the market is valuing them at. Well, here I'm going to show you how the use of trailing earnings per share and forward earnings per share significantly changes our disposition about a particular equity. If you recall, under the discounted dividend, the dividend discount methods, we determined that a share was fairly valued if the intrinsic value equaled the price selling in the market. And then we also had a determination of what was overvalued and undervalued. Well, we can do the same thing for ratios. We can calculate the ratio of a company and compare that to some specified value. Now, we'll get to what we're comparing it shortly, but let's say we're going to compare it to some specified value, some industry average or some long-term average, let's say. And if the ratio is in the neighborhood, when I use equal signs in this respect, I'm pretty much saying in the neighborhood. If it's in the neighborhood of the specified value, we would say the company is fairly valued. If our ratio comes in significantly lower than the specified value, for instance, a PE ratio of 10 for a technology company, when all of its comparables, all of its peer group, I shouldn't use the word comparables yet, we'll get to that, but when its peer group is averaging 20, we might say it's undervalued. We might say it's undervalued. There may be a very good reason why it's undervalued. We can't just say, oh, it's undervalued. It might be correctly valued given its pathetic position, let's say, if it's that far off. So there may be a reason. And remember, if you go back into the FRA series, one of the key questions you want to continually ask over and over and over again is, when we see a ratio or we see some result, why? So even though you get a ratio that may be less than some specified value, less than the industry norm, that's why we use the word it may be undervalued. It just might be, but there might be a very good reason why. Before we run to the word undervalued, we would say, why is it that way? And if we can't find the why, okay. If the ratio comes in well above the industry norm or well above some specified value, we would say that it is overvalued. Now, here is the problem in using trailing 12 months versus a forward estimate. So let's figure out the PE ratio for this company right here. Here's its earnings per share over 4 quarters. Here's year one. Here are the actual results, and here's what's estimated. And this, I've just drawn this out as an example of how this is done. Most companies wouldn't show this kind of linear growth in their earnings, but let's just do it for now so that you get the point here. So we have actual and estimated. The industry PE is 15 and the price of this stock is $36. All right. So let's calculate a PE ratio for the trailing 12 months. Whenever you see TTM like this, and that means trailing 12 months. Equals, our numerator is always our price, $36. Our denominator is our monetary flow, whatever it is. We're going to use the trailing 12 months on earnings. They sum to $1.20. So 36 divided by $1.20, we're going to get a 30 times multiple. The industry standard is 15. We've got a 30. So we might want to say it's overvalued. It is overvalued. However, if we take the PE and we use a forward PE on this instead, we're going to use the forward earnings per share, not the trailing, not the actual. We're going to use our estimates. We have $3.12. So if we take 36 divided by our forward PE, our estimates, we get a multiple of 11.53 times earnings. Industry average is 15. We go from very overvalued to moderately undervalued. So it is undervalued now. And if we want to know how much it's undervalued, we can always calculate a target price. We can calculate a target price for this stock. If we feel that it should be trading at the same price as its peer group, that is called the law of one price, and I'll discuss that when we get to comparables. If we think it should be trading at the same PE of its peer group, that means it should be trading for 15 times earnings. And what are earnings? Forward earnings are $3.12. Which means we should have a price of $46.80. We've got a price of $36. So even taking the industry average and multiplying by the price, we see that we're undervalued roughly by about $10 and change. So that is a roughly 30% underpricing. Somebody would put a buy on that, depending on 30%. If 30% is a big number, they might actually call it a strong buy. I'd call this a buy, not a strong buy, but I'd call it a buy. But it's certainly not overvalued. So you may, in the marketplace, find a stock that suddenly has a PE of 30 while the rest of the industry has a PE of 15 without understanding that it might be trailing 12 months. And if you look at it at trailing 12 months, yeah, because it's ramped up and it's going to ramp up much more than that in its earnings, you've got to make sure that you're looking at the PEs on a forward basis. Now, that being said, let's assume that the industry PE average was 15 on a trailing 12-month basis. Was 15 on a trailing 12-month basis. And we had 30 on a trailing 12-month basis. The question you have to ask now is this a very young company and the peer group is an older group of companies? Because if it's an older group of companies, the trailing 12-month PE might be fairly indicative of what the forward 12-month PE might be if the growth rate in their earnings per share is single digits. And this is a young, aggressive company growing at double digits. Then you'd have to get into something called a justified PE. You would say, is this PE justified? Sure, it's much higher, but is it justified? And if it's justified, then we're good. So let's move on and see if we can't deal with that issue, justified PE. So you'll recall when we did the dividend discount model that we were able to get to our value on a stock by taking the dividend and dividing it by R minus G. Well, let's assume for a moment, just for the purpose of this, let's assume that after we calculate the present value of all future dividends, it equals the price. So that we have a fairly valued security by this methodology. Then at that point, we can say that P naught equals D naught over R minus G. If the intrinsic value we got to equals the price, we could just substitute the price and say, well, the price actually equals this because that's what the intrinsic value equals. Very good. Let's divide our price by our earnings per share and our dividend by earnings per share. We don't need to do the denominator by earnings per share because if we divide the price by earnings per share and the denominator by earnings per share, we'd get the same ratio of the result. So we're dividing P naught and D naught by earnings per share. So let's rewrite that and see what we get. We would get P naught divided by EPS equals, in our numerator, we get D naught divided by earnings per share over R minus G. We can name some of this stuff now. Well, what's price divided by earnings per share? Price divided by earnings per share, that's your PE multiple. There's your PE multiple right there. What is dividends divided by earnings per share? If earnings per share are $3 and our dividends are $1.50, that means we're paying out 50%, right? So this is really the dividend payout ratio. That's really the dividend payout ratio. So we can rewrite this in terms of the PE ratio. We can say that the PE ratio is equal to the dividend payout ratio divided by R minus G. I just want to make that one step clear now. All we've done is we made an assumption that whatever intrinsic value we get by taking the present value of a perpetuity, whatever intrinsic value we get, we're assuming that it equals the price in the market. We're going to say, okay, well, let's say that it does. Then we can substitute the price in here. If we then divide the price and the dividends by earnings per share, we have our ratio, our PE ratio, equaling this. Now we're going to say some interesting things about this, and we're going to come up with what's called a justified PE. In fact, this right here, what we're showing, this formula right here, this is what a justified PE equals. We can arrive at a justified PE by this. So let's say that we didn't know the PE of a corporation. We don't know the PE of the company. But we do know its dividend payout rate, we do know our required rate of return, and we do know the growth in the dividend. We can come up with what a PE should be, what is justified by the fundamentals if we know this, and we can compare this with price divided by earnings per share to see if it is actually that. So here we are. Our price earnings ratio is equal to our dividend payout ratio divided by R minus G. This is what we got to by assuming that the intrinsic value and the market price were equal, we've got to this. This is called, as I said, the justified PE. In other words, it is justified by the fundamentals. And let's see how so. So PE is positive. If we have the PE here, it is positively related to, and when we say that the PE is positively related to, we mean that it will increase if some of this stuff changes. So how will the PE increase? Well, number one, if we leave R and G the same, if the dividend payout ratio increases, the PE ratio will increase. So it is positively related to the dividend payout ratio, as far as this formula is concerned. But if we use logic, we can say, well, that's kind of questionable. That's kind of questionable because the higher the dividend payout ratio, the lower the retention rate, which means the lower the reinvestment. So where is future growth coming from? Unless we're talking about a very mature company that spits off cash that we're paying out. The higher our dividend payout ratio, the lower our reinvestment is in the company. This is called the dividend displacement of earnings, where we're using our earnings to pay out entirely in dividends. This is a REIT, by the way. So if you're using this for a justified PE for a REIT, you'd be okay in saying, yes, the higher the dividend payout ratio, lower the retention, lower reinvestment, that's fine, but the PE would be positively related to that. What else is it positively related to? Well, the denominator. The smaller the denominator, the better. So if we have a constant dividend payout ratio, but our denominator keeps getting smaller, that's better. But we have two components in the denominator. So if we left the discount, the required rate of return the same, we can see that the larger G gets, the larger PE gets. Remember, we're just looking for positive relationships. If we say the smaller R gets, the bigger P gets, that's called a negative relationship. We want positive relationships. The bigger the numerator, the bigger PE, the bigger G, the bigger PE. Now this makes sense. If it's related to G, the higher the growth rate in dividends, the higher the justified PE. No one can argue with that. Especially if the growth rate in dividends is not eating into the dividend payout ratio. In other words, the dividend payout ratio, let's say, is 40% and stays fixed at 40%, but the dividend growth rate is positive and getting bigger. One company with a bigger growth rate versus a smaller, that's justified, isn't it? Well, what is G? What is the growth rate in dividends? We know that it is 1 minus the dividend payout ratio, 1 minus the dividend payout ratio times ROE. So if we're leaving the dividend payout ratio constant, we can see that G is positively related to ROE. So if PE is positively related to G and G is positive related to ROE, by transitivity, the price-earnings ratio is positively related to return on equity. I think we can clearly say, yeah, that makes sense. One company that can generate 10% return on equity versus one that can return 20% return on equity in the same industry, the one returning 20% would probably justify a higher PE ratio. I'm not saying it would have one. Maybe it has the same ratio, but it would justify a PE ratio higher. So if we did see a PE ratio of 20 on one and 15 on the other, we would say, well, the one that has the higher return on equity has the higher PE ratio. That's kind of justified. So we wouldn't jump to, oh, it's overvalued if it's justified, right? So the PE is positively related to ROE, and of course, it's negatively related to the required rate of return, negatively related to R. So if our required rate of return goes down, we don't need these big, huge increases in growth and these big returns on ROE to be satisfied because our hurdle rate just dropped. So as interest rates in an economy rises, our required rate of return must also rise. And as interest rates rise, our denominator gets bigger, which means our ratio gets smaller. It would justify lower PEs. It would justify lower PEs. And as interest rates drop, if everything stays constant, it would justify higher PEs. Now, you may be saying, well, that doesn't really make sense based on what I've seen. I've seen that as an economy goes through its expansion phase, As the bull market enters its later phases, typically, certainly not in 2014, 15, 16, but typically the central bank would be raising interest rates because inflation would be a problem. And as interest rates go up, it should take some of the steam off of the market, but it doesn't. We still run a bull market going into interest rate increasing cycles. What gives? Well, what gives is you have three variables in here, not just one. Sure, as interest rates go up, that may be the case, but interest rates are going up because the economy is doing really well. Chances are your G is going up as well, and your dividend payout ratio may be changing as well. So you may have the fundamentals that are improving at a faster rate than the required rate of return is increasing, thereby still giving a lift to equities. So you can't just take it in isolation and say, but isn't there a relationship? Higher interest rates, lower stock prices? Yes. The higher the interest rate, the lower the pressure. Let me say that again. The higher the interest rate, the greater the pressure on lower prices. But typically interest rates are raised in an environment of excellent economic activity, which means that the fundamentals of the business probably are still overcoming the negatives of an interest rate increase. And then you could argue it the other way around, right? That as the interest rates are dropping, the economic environment is also deteriorating at the same rate. So we can't have just one rule in a situation like that where there's 3 or 4 inputs that are all kind of related, they're all correlated and all changing at the same time. So there we go. Long-winded explanation of a justified PE. All right, the second part of this learning objective was to look at multiples based on comparables. So let's take a particular company, and we know that we can calculate a number of different multiples: price to earnings, price to book, price to cash flow, etc. And we can compare all of ours, again, versus, in other words, compared to, all of ours, compared to some benchmark value of the multiple or multiples. And where do we get these benchmark values? A closely matched individual stock. So another company that looks very much like ours in size, in asset size, in sales, etc., as close as possible, that does what we're doing, we can use that. An average multiple of a peer group or an industry, we can use that. An average multiple derived from trend or time series analysis. And I'm going to show you an example of both of these. Whatever we're using, we typically call them comps, comparables. So what are the comps for a particular stock? If you ever hear someone use that language, what comps are you using? In other words, what are you comparing your company with? What are the comps that you're using? Is it a particular stock? Is it a peer group, a particular industry sector? Is it a past time series or trend analysis that you're using? What are the comps? Now, the rationale for comparing one company versus the benchmark value is called the law of one price. I don't like the word law. Whenever I see the word law in things like economics and finance, I want to change it to the word tendency, not law. But there it is. It's the law of one price. Don't think of it as a law. You'll be better off if you think, well, it's a tendency. How's that sound? It's a tendency of one price. Identical assets should sell for the same price. Okay, I agree with that. Identical assets should sell for the same price. They don't. They don't always have to. Here's the problem. What's the word in this sentence that would cause you the most grief? The most grief, right here, identical. Because you're never going to find identical assets in an equity market. You're going to find one company whose shares, whose common stock, is identical to another one. Or two companies that are identical to each other, that there they go, they're exactly the same, they're identical. That's the big problem there. We have nearness, but not identity. So we should have the tendency of one price. Assets that are kind of like each other should sell for about the same price. There you go. There's a nicer way to say that statement, right? So we'll end these two learning objectives with sort of just a comparison to show how these things apply. Let's look at a list of companies here, A, B, C, D, and E, and we'll look at their price to sales ratio. And I've ranked them in order, A, B, C, D, I put them in order, 0.14, 0.26, 3, 2, 4, 8, 6, 4. So looking at this, we might be able to say, and I, again, might, A appears undervalued, and in quotes I put relative to its peers. It appears undervalued relative to its peers. It may have its own good reasons for being undervalued, but here's the deal. If A is undervalued, it might be economic conditions or industry conditions that are undervaluing A or causing A to show a price to sales ratio that is low. It may be. But if that were the case, the peer group would also be susceptible to that. So by using the comparables, all we're doing is we're isolating the industry and the group that it's in from its own behavior. So that if A is justifiably undervalued, there might be something specific with A causing it, but we couldn't say A is undervalued because the industry is out of favor. You could never say that. Because if the industry were out of favor, these would all change. The whole industry, the whole peer group would change. So when we compare A with the peer group, whatever affects the entire group, whatever affects A, will affect everyone else. But if there is some alpha specific event, alpha that affects A may be justifiably undervalued if it is an A problem. So A appears. I'm not saying A is. Again, you cannot say A is until you answer why. A appears undervalued relative to its peers, or you could say E appears overvalued relative to its peers. We don't know. Maybe the bottom end here is the right place to be and E is overvalued. Maybe the top end is the right place to be and A is very overvalued with B somewhat overvalued. We don't know until we go further. So there's one way to use comparables. Here's another way. Take one company and go back in the years 2016, 15, 14, 13, 12 and have a look at the PE ratio. 15.8, 16.1, 15.2. We'd call that fairly close. Given that we can engineer earnings, we'd call that fairly close. But then we deviate significantly here. We go to 13.6 and 11.2. We could make the statement that this company appears to be undervalued relative to its historical trend. So the comparable for this company is its historical trend, and it appears undervalued relative to that trend. Is this an alpha issue or a beta issue? If this is a beta issue and just a market issue, we should expect it to correct. That might be an undervaluation. If this is an alpha issue and it's something specific to the company, it might be justifiably so. Again, ask why. Well, we are on our next learning objective, LOSI, which has keyword describe, and that is all we're going to do here is describe. Describe enterprise value multiples and their use in estimating equity value. So, the approach this takes is saying, look, rather than estimating the value of equity, why not just estimate the value of the enterprise as a whole and compare that with other enterprise values? So rather than estimate the value of equity, we are going to estimate the value of the entire enterprise with this imposing formula. That's actually not that bad. This first term here, we take the price of the company and multiply it by the number of shares. That's just its market cap. That's the market value of equity. That's the market cap of the company. To that, we will add the market value of all the preferred shares, because this only counts the number of common shares. Well, they're a preferred share, so that adds to the value of the company, the enterprise value. So we'll add the market value of the preferred shares, and if I bought up all the common shares and all the preferred shares, I still don't own the assets. Why? Because I gotta pay off all the debt. So I gotta reach in my pocket and buy off all the debt at market value. So I'll add the market value of debt, but that bank account is mine, so I can subtract cash. This is typically referred to as the cost of a takeover. Most useful when comparing companies with significant differences in capital structure. That should be obvious. That should be obvious because you have to include the market value of the debt, the market value of the preferred, and the market value of the common. So if you have companies with differences in capital structure, it doesn't matter. It'll all be caught in that one number, minus cash, of course. So a good ratio to use in this case, once you calculate enterprise value, your denominator would be EBITDA, because it does also take out the capital structure. Depreciation, amortization are gone. Interest is gone, which is a reflection of the amount of debt you carry, and taxes are gone. So you'll get EBITDA, enterprise value divided by EBITDA. Now, here's the one issue with this. Enterprise value may be difficult to calculate for companies whose debt is not publicly traded. Who are companies like that? Well, a company that just goes to a bank and looks for a $250 million term loan over 5 years. The bank says, yeah, we can do that. With a couple of our friends, we can put that deal together. It doesn't hit the market. Well, what's it worth? Well, the bank loan is probably worth what it's worth. It would be your answer. Well, if they owe $250 million to a bank wants $250 million back, you'd have to pay it back at $250 million. That's a good argument. Here we have a describe, and that's pretty much what we're going to do as well, describe. Describe asset-based valuation models and their use in estimating equity value. And you'll notice that for the last learning objective, it may look like I'm going quick over them. But here's the deal. There's a lot you got to know for level 1. There's no point in going a lot further upstream than you have to. If calculating and interpreting helped you with describing, I would do it. But in these cases, it doesn't. Describing is enough. The LOS asks you to describe. You're not going to be required to calculate anything on these, but you simply just have to describe it to understand the difference. That's all. So asset-based valuation uses the market values of a company's assets and liabilities to determine the value of the company as a whole. And now, if we're using the market value of the company's assets and liabilities, what we're saying here is that the company's really not much worth much more than the market value of their assets and liabilities. And that's it. More frequently used with private companies, because there's no market-determined value there. Companies with few or no intangibles or off-book assets. The more intangibles you have, the harder it is to get an objective market value. Not that any market value is objective, but if somebody's willing to pay me $10 for something, that's as objective as I'm going to get. It's worth $10. It's worth as much as somebody's willing to pay. That's not, it may be a subjective valuation on their part, but from my point of view, $10 is coming into my pocket. That's as objective as it gets, right? With few or no intangibles, or very few off-book assets or no off-book assets. An off-book asset is reputation. You can't value that. Companies with high proportion of current assets and current liabilities. Companies being liquidated. And financial companies, because financial companies tend to list most of their current assets at market, at fair value. Not suitable for company whose market value of assets and liabilities are difficult to determine, or have a significant amount of intangible assets. So here, all we're doing, if you look at what it's useful for, especially the private companies and the companies being liquidated, is that there's not a lot of intangible there. There's probably not a lot of reputation effect. You have some current assets, some current liabilities. What can I go out and buy them for? So you're really looking at the market replacement value of what a company is and saying, look, I can replace it for this price. That must be your value. Well, let's do some calculating here, just to flex our muscles a bit. Here's a company, and we have 10 years of the company up. We have some actual results up to year 5, and from year 6 onwards, I should put an E down here to let you know that these are estimates. These are estimates. So, using a dividend discount model, find the intrinsic value of this company, assuming the required rate of return is 10%. And whenever we're given something like this and all of this data, it tends to get overwhelming right away. It's like, well, where do I start? Where do I start? Always start with the formula. Using a dividend discount model, find the value, find the intrinsic value. So I look at my dividends. Are they flat? No, they're going up. They're going up. So I'm going to use a Gordon growth model. What I think I have here is a growing perpetuity. And if I've got a growing perpetuity, instead of using D0, I'm going to use the first year dividend D1. D0, 1 plus the growth rate. So I'm going to use D1, I'm going to use R minus G, and I'm going to value it. Now, where am I going to value it? Well, we actually have results up to here. So that means my valuation will be as of this date. I'm going to value it as of the end of that particular period. So, do I have what I need to value it? I need R, which I have is 10%. I need G, and I need D1. I can't figure out D1 because D1 is D0 1 plus G. My first step is to say, what G am I going to use? Well, that's easy enough. My estimate in the future for year 10 is $3.10. So $3.10 must equal, I'm at 243 right now, so 243 must grow at that rate for 5 years, right? And if I count 243, it must go 1 year, 2 years, 3 years, 4 years, 5 years forward. So my G must be the growth rate in dividends, because G is constant, remember, so it's 1 plus G to the 5 multiplied by 243 will get me to the 310. So how do I solve that particular problem? Well, I would have 310 divided by 243. The first thing I'll do is divide both sides by 243 to get rid of the 243 on this side. I'd have 310 over 243. I want to get rid of the 5, so I'll take the fifth root here. Then I'll have 1 plus G left over here. So if I subtract 1 from this side, I'll be left with G. If you do the calculations, you'll get 4.9907%. Let's call it 5%. There we go. We have 5%. Now I'm in a position to figure out D1, which is my numerator, right? So what I will do is I'll take D0, 1 plus G. What is my D0? It's 243. So that will equal $2.43. 1.05 will give me 255. 255, which there we go is 255. It actually is. The estimate is actually 5% higher. So 255. So now I'm in a position to calculate my intrinsic value. Do I have my D1? I certainly do. 255. Do I have my R? I do. Is 0.1 minus. Do I have my G? 0.05. And I will get $51. $51, what is the share price? What is the share price of this thing? $50.80. And I'm at $51 using the dividend discount model. What conclusion would I make at this point? I'd say, hey, it's fairly valued. It's absolutely fairly valued. We're okay. Number 2 here, find an intrinsic value assuming the average PE for trailing 12 months is appropriate. So the average PE is appropriate. So if we're going to use an average PE, we can't use the year we're in because that's what we need to compare this against the average. So we'll just use the average from these years. So our PE, we will take 13.2 plus 16.4 plus 15.2 plus 1.4, and we would all divide that by 4, and that gives us 14.7. 14.7, and we have a 12.7. 14.7 is the average. We're at 12.7. We can say we look like we're undervalued. Well, let's figure out what the intrinsic value of the company is if it has a PE, if it should have a PE of 14.7 instead of 12.7. If it would have been the 14.7, which is the average of the last 4 years, the stock price should be $58.80. We have an undervalued stock at this point. It should be $58.50. It's $50. We have an undervalued. What is the problem with what I just did? Well, I'm using results with earnings that are significantly lower than what we're going to have going forward. Significantly lower. If I use the forward earnings, if I had used the forward earnings to calculate that, I might have a different result altogether. So 58.80 is undervalued. Our dividend discount model says we're fairly valued. This is where you got to start using judgment. This is where experience comes in, and you have to start thinking which one is do I use? Let's try a third way. Let's try to use a third way. Let's do an asset-based valuation. And we'll have a look at the balance sheet at the end of year 5 for this company. We have cash, accounts receivable, and inventories. We have net fixed assets of $50,000 for total assets of $100,000. And we have accounts payable, notes payable, a term loan payable, and shareholder equity of $55,000. And we're going to assume that accounts receivable inventories are at the carrying value. Here is their market value. The market value of our net fixed assets is 10% higher than this, multiplied by 1.1 to get our market value. As far as our accounts payable, our note payable, and our term loan payable, we got to pay our suppliers, so that's probably market value. The 17 and 25 is owed to banks, most likely, so banks aren't going to negotiate. They want their $42,000, so we'll call that market value. And for shares, let's say we have 1,000 shares outstanding. Let's see what our asset-based valuation of this. We will start with the market value of our assets. And we have cash, so we'll add our cash of $5,000 because that's what it's worth, right? $15,000. Our receivables are at market value. We'll add our $30,000 for our inventories, plus 1.1 times 50, we'll add $55,000. We get $105,000 for the market value of our assets. Let's look at the market value of our liabilities now. We just do the same thing, $3,000. In the real world, this is far more complex. This is just to show you the mechanics, right? We'll add $17,000. We'll add another $25,000. And that will give us $45,000 for the market value of our liabilities. So the market value of our assets minus the market value of our liabilities, that's $105,000. Minus our $45,000 gives us $60,000. There's the market value of the company, $60,000. So our value, our intrinsic value, will be our $60,000 divided by the number of shares we have to get a price per share. We'll get $60. Our price is $50.80. Using a dividend discount model which uses forward estimates, we get 51. Using a PE, we get 58.50, but again, the PE, the average we compared it with, the average was trailing 12-month averages, not forward, so we get 58.50. And using market value of assets and liabilities, we get $60 per share. So you would have to now use your judgment and say, well, what do I think? I myself tend to lean towards this much more heavily. I tend to lean towards the dividend discount model more heavily than I do with the other ones. Because market value is hard to figure out. I don't know if all those people are going to pay me. Accounts receivable of $15,000 market. I don't know if I'm going to get it all. Am I really going to get $30,000 for my inventory if I have to liquidate it? I don't know about that. How long am I going to have to sit on my net fixed assets? I'm not going to get $55,000 today. I put it up for sale. It might take 6 months to sell. During those 6 months, property's not free to hold. Anybody who owns property will tell you it costs money to hold. To just hold property, you got property tax, you have to have insurance. Try to get insurance on an empty commercial building and see what an insurance company will tell you. Oh, the price goes up. Why? You might have a fire sale. You just might have a fire sale. More empty buildings light up on fire than full buildings. I wonder why. Because it costs money to hold it. If it burns up, at least I get the insurance money. If I can't sell it, I'll sell it to the insurance company, right? That's a fire sale. So these market values, I got a lot of uncertainty about that. The PE, I got a lot of issues about using the trailing 12 months instead of the forward. The DDM is the only one that uses forwards. I'd put more weight on this and say 50, fairly valued. Secondly, the 58.80 and the 60 is about a little less than 20% higher than where we are right now. There's got to be some easier fights to win than this one. I'd tend to pass on it. I'd say fairly valued. Let's move on.